The last major category of behavioral biases that we'll talk about is prospect theory. And prospect is a term in psychology meaning your outcomes, your prospects, what might happen. And so this refers to people choosing an alternative that may not be rational or is inconsistent with other observed choices or inconsistent with other behaviors that we know are rational. Based on, well, essentially whether or not you think you're going to win money or think you're going to lose money, whether you think it's going to be a gain or a loss. And so people can change their degree of risk aversion when faced with a loss rather than faced with a gain. So here's just a couple of examples. The first is just that very simple example of the wheel again. So here, spin the wheel, and I don't have to pay anything if it's 1 through 99, but if slot 100 comes up, I got to pay 10 grand. And the other one, I have a certain loss. I have to pay. It's a 100% certainty that I'm going to lose money, and so people try to avoid that, and then they spin. So just remember this idea of risk aversion, and I just want to do a little bit of quick review of this thing of risk aversion that we did very, very early in this semester. And remember, there's two necessary assumptions. The first is that utility is increasing in wealth, and so as wealth gets bigger, utility gets bigger, but marginal utility is decreasing in wealth. And so that means that for every extra dollar I earn, the increase in utility gets smaller and smaller and smaller. And so this curve is increasing, but it's increasing at a decreasing rate. And so therefore we would say this is a concave curve. And if you remember the definition of concave, then what this is saying is that if I have some point x1 and I take the function value, and I have some point x2 and I take the function value, then if I draw a line between these 2 points, then the midpoint of the line I just drew, which is sort of the average of the functions, that must be less than if I start here and here and then just take the function of the average. And so if it's the case that the function of the average is greater than the average of the function, then it's a concave curve. Very simple principle. And so the idea is that standard utility is concave everywhere. People are risk averse. The utility loss for a decrease in wealth, so if I have some sort of decrease in wealth, the loss in utility exceeds the utility gain for an increase in wealth. And that's just a function of the nature of this idea of risk aversion. And so people don't flip $1,000 coins. They don't flip a coin for $1,000 because, yes, it'd be nice to have an extra 1,000, but the utility loss from losing 1,000 far exceeds this. And so one of the things from this idea of concave utility is that people are risk averse and they don't flip $1,000. They don't do $1,000 coin flips. But what if utility were convex? Well, now the utility loss for a decrease in wealth is smaller than the utility gain from an increase in wealth. And so now we would say that people are risk loving as opposed to risk averse, or they increase their utility in risk. And so, yeah, they would flip $1,000 coins. So, okay, back to different prospects. And so here's the idea. For a given starting point, people exhibit different risk aversion for gains. Just added that quickly. So for a given starting point in wealth, people will exhibit risk aversions relative to gains, but risk-loving behavior in the context of losses. And so it'll be concave utility going this way, but convex utility going that way. And that is the underpinning of this idea of prospect theory. Depending on what your prospects are, you behave differently, and this is considered a behavioral bias. And so here's the standard example. I have two groups of people, and in one room I have one group of people and they're offered one alternative, and in another room I have another group of people, they're offered a separate alternative, and then I see how these two different groups of people behave relative to what I expect them to do. So it's group one, and they're in this other room, and they're faced with the prospect of a gain. They're given a choice where they might make money. And they have to choose between a guaranteed $50 gain, I'm going to hand you $50, or flip a coin, and it's either going to be $100 or zero from a coin toss. And so the expected gain is $50, just like here, but there is uncertainty. And so people choose, because they don't like risk, they choose the $50 cash as opposed to the probability of winning $50, even though it's a 50-50 probability. And so because of concave utility, the difference between plus 100 and plus 50 is less than the difference between plus 50 and plus, well, nothing. And so people choose the guaranteed $50, and this is consistent with risk aversion. In the other room, there's a second group of people, and they are given a separate choice. And the choice these people are faced with is the prospect of a loss. And so they can either choose between a guaranteed loss of $50 or lose either 100 or 0 from a coin toss. But of course, the expected loss is still $50 and there's uncertainty. But because of concave utility, we would expect the difference between negative 100 and negative 50 to be greater than the difference between negative 50 and negative 100. So people should choose the guaranteed loss of $50, but just like the wheel, they choose the coin toss. And this is not consistent with risk aversion. And so instead of people exhibiting a consistent risk aversion curve, which is concave everywhere, we observe them actually looking at a curve like this, where they actually switch from concave utility to convex utility. And the idea is that if people are faced with different prospects, their utility changes. Well, it shouldn't. Your utility should not change. And so that's why this is consistent with a behavioral bias. People behave differently when they are faced with different outcomes. That's another type of behavioral bias. So we've got our information processing errors, which cause us to come up with incorrect expectations. And then we have our behavioral biases, which cause us to sort of make incorrect decisions regardless of whether or not we have correct expectations or not. And we have a few of those. Obviously, we haven't been through every possible one, but this will allow us to sort of get to these other discussion topics, which we'll talk about in lecture. We'll talk about sort of how these relate to the efficient market hypothesis and whether or not some of the things that this predicts are consistent with some of these behavioral biases. We'll talk about bubbles, the dot-com stock bubble. We'll talk about the housing bubble. We'll talk about gold. We'll talk about Bitcoin. We'll talk about a whole bunch of different stuff. Maybe this CUBA ETF, maybe that was sort of a bubble or an anomaly. And we'll talk about other things that don't seem to make sense, that may not be consistent with efficient markets, but are maybe consistent with some of these behavioral biases, and sometimes these are referred to as anomalies. So small stocks and value stocks, we spend a fair amount of time talking about that. We'll talk about that in the context of behavioral finance. We can talk about momentum. Daily, weekly, monthly, annual, multi-year. And we can talk about some of these calendar effects, the January effect, the day of the week effect.